And we are live. Hello, everybody. Welcome back to the first show of 2026. I'm delighted to be joined by Andrew Gibb. He is the CEO of Twinstake, and we are going to cover a couple of pretty important topics today. We're going to go through the current state of institutional adoption, the current state of staking, and maybe even a couple of 2026 predictions. Andrew, how are you doing today? Are you well?
Very well, thank you. Appreciate you having me on.
Not at all. Thank you for making the time. I know you're a busy man. Thank you for being here with the Blockchain Won't Save the World and LinkedIn audience. For those people who don't know you, let's jump straight in. How did you find your way into Web3? I know you started with an institutional background, but if you could give people who don't know you, your brief journey into Web3 and now being CEO of Twinstake.
Absolutely. So my career started really in traditional finance, like you said. So I was 10 years at JP Morgan. I'm in London at the moment. I was with the bank here for 5 years and then in the US also for 5 years. Through that time, I was sort of learning about crypto, getting interested in the tech, etc. I think it was the back end of 2011 that my interest was first peaked. But I was, working within a bank, and I'm not sure if you've kind of followed Jamie Dimon's route through crypto himself, but he's basically done a 180 now. But at the start, it was a very
his babyface crypto arc.
Yeah, I mean, there was notes going around the bank saying anyone that's investing in crypto should not be working here. And it was like, okay, yeah, but half the bank was sort of on the side, reading about it and opening wallets, etc. I was one of those people. So always had the interest in it. I remember it was a university friend of mine that really got me into the tech, and it was one of those. Everyone's got this crypto story, right? Mine is. Really reasonably early, right? Back end of 2011. And we're having a conversation. He's like, this is a brand new asset class. Let's just put $5,000 into it each and park it away for the next 20 years and see what happens. So I think I was like 21 at the time. So I was like, no, $5,000
I was having very different conversations with friends at the age of 21 with much smaller amounts of capital, but it's a good start. Some people have the Bitcoin white paper journey. This is the institutional investment banking side of the journey. So I'm interested to hear it.
I didn't do it. I should have done it, obviously, but I didn't do it at the time. But obviously I was still interested in it and continued that interest through my journey at the bank. But at the time, my career was really focused on the traditional side. I moved from the New York office back to London just before COVID. And I moved to take a role covering or heading up one of the risk desks at JP Morgan. So it was liquidity risk and interest rate risk for the UK investment bank and covering the EMEA bank branches as well. So it was a really good role, and I learned a lot being in traditional finance. I think it's got some real big advantages to working in such a place. You kind of understand how to work, how to solve problems, how to build teams, how to manage particular stakeholders. And obviously with my focus running one of the risk desk, I understood risk. And really that's helped me through my sort of crypto journey, because there's not really that much difference between risk management in crypto and risk management in a traditional sense. Obviously there's different challenges to that, and the volatility in crypto is standard deviations higher than that in traditional finance, but the concepts are the same. And so I've managed to, look to take what I had at the bank and use it in my journey. But I left the world of traditional finance just before COVID. So I think everyone has a sort of crypto story, how they got into it, and everyone sort of has a COVID moment story. And that was when I left the bank, was my COVID moment. And I really wanted to do something a little bit more impactful. I think I was sat at my desk alone in my house and thinking about the impact I was having just in general, and whether I was really moving the needle in the way that I wanted to. And the answer to that at the time was no. It's difficult to move the JPM share price by yourself, right? So I thought, I wasn't being as innovative as I could have been, and the pace of change within the bank is, it's very slow. And given my interest in all things crypto at the time, I thought that was my perfect moment. 10 years at the bank, COVID is rife. I'm getting out of here and changing my life a little bit. That's when I made the pivot over into the world of digital assets.
Very good. And it takes a serious level of self-reflection or introspection to say, am I really moving the needle in the world enough for where I am and what I've done? Most people are just kind of trying to make it through Monday to Friday. So to have had, and I guess this is probably the difference between people who end up as CEOs and people who end up doing whatever it is they do instead, is that level of, have I really fulfilled my potential? Is there something bigger for me with what I've learned and what I've done? And so for you, it was Twinstake.
There was one venture between, but it was that leap.
It was the
And I would
direction.
recommend everyone does that introspection and does that and takes that risk at whatever period of their life, to be quite frank, because there was a lot of positives for working in the world of traditional finance and banking, and it suits some people. Some people are lifers, right? They go in as a graduate and they retire there, and that's great. And there's plentiful sort of opportunities, and you can move regions, you can move departments, and you can go up the ladder. And that might suit some, but I felt very sort of confined within, sort of shrinking in many ways. Even though the roles were getting bigger, I felt personally that I was shrinking and I had a lot more to give. And so it was a bit of a leap of faith, because you go from this perception of security, right? JP Morgan's not going to go anywhere, and so you have that. Whether it's an illusion of security or not, it's perceived security, and then you have to jump and do something that may fail. And that was the biggest sort of, certainly the biggest leap I've taken in my career. I definitely have no regrets in doing so, and I managed to, from a personal perspective, become a lot more expansive. There was a small, I left the bank in 2020 and set up Twinstake 4 years ago. So there was a startup in between that didn't work out so well, and I think that's important. It's an important part of the journey, because not everything is an overnight success, and not everything works, but you learn equally as much from the ones that don't as the ones that do. So yeah, it's been an interesting time since leaving, but one in which I've personally felt was right for me and gave me the ability to grow.
Fantastic. And so on to Twinstake. I mean, as they say, the critical factor for everyone's overnight success is the 10 years of preparation running up to it, or in your case, the 4 years and 5 years of preparation running up to it, or maybe the entire length of your JP career before you got there. But tell us about Twinstake. So there was a startup in the middle that was your practice run, and then Twinstake. So what problems is Twinstake solving for the world, and what's been kind of the 101 on the business?
So Twinstake, for those that don't know, is an institutional staking provider, an institutional validator. So we spotted a gap within the market, within the segment, and really have sort of leaned into the institutional side of crypto. It's a really, you obviously know a lot about the space. What I find very interesting is the interaction between both sides. There's between retail and institutional, and sort of crypto native and TradFi. We're here to sort of service everyone, or like everyone's in the same industry, right? We all want the industry to succeed, but we have slightly different views of the world and different ways in which we approach things. So given my background, and I know and understand how institutions work, we noticed there's sort of a gap within the staking market for that true institutional player. So I think we weren't first in the market. There were some incumbents, quite large incumbents, quite broad offering. We wanted to go in and sit right within the segment and say, we want to be the provider of choice for large and sophisticated institutions. And we had a thesis, as many do, that sort of traditional finance and decentralized finance will converge. At what pace and timing, we're not sure, but we have high clarity on the thinking, conviction in that's the way the world is going to go. And we wanted to make sure that we were servicing the largest and most sophisticated institutions. So Twinstake was set up 4 years ago. It was set up as a joint venture between two companies. One called Nethermind. Nethermind are one of the large Ethereum clients, very technically deep within the Ethereum ecosystem and beyond now. Some world-class, fantastic engineers. Close with Thomas Stanchak, their founder, excellent guy, now essentially running the Ethereum Foundation. So amazing to be part of the journey with those guys. And then on the other side, there was a Web3 and venture company called WebN, which rolls up into as now Howard ecosystem. And with that comes institutional know-how and expertise of how institutions work and what they want. So it's a really nice marriage and a really nice start in life, because you have the technical expertise to understand what it means to develop the tech, and then you have the institutional know-how, capacity, and network and ecosystem to know what institutions want to be built. So that was a really nice start in life. There's different models for different startups, and often, it can be VC backed and founder led, or we went the sort of joint venture route, and it gave us a nice early start because we had that inbuilt sort of expertise and network. And we've spent the last 4 years solving that problem for institutions, figuring out what it means to be an institutional staking provider and service the largest and most sophisticated amongst them. So we, coming up to 4 years now, we've the types of players that we service, we kind of segment the institutional space within different kind of silos, but we've got a really excellent market share in the ETF issuer segment, for example. We service some large asset managers, some very large hedge funds, family offices, VCs, and we work very closely with foundations as well. We cover most of the kind of top proof of stake assets by market cap, and we're really focused on, obviously, security. That's paramount to being an institutional provider in any capacity. That was the first thing we kind of built out from an infrastructure perspective, because the industry is built on trust and credibility, but certainly where we sit, it's all about trust. We're servicing our clients and they're delegating those assets to us. We're non-custodial, we don't hold private keys in the same way that others do, but we still, you're delegating your assets to us, and there are downside risks to the potential downside risks to staking. So that trust and credibility is incredibly important, and that's where we started. Then we looked at the performance of our infrastructure. Then we looked at things like data, reporting, and analytics. Then you start to get a little bit of white space between what a retail offering might be versus an institutional offering. Is it worth me talking about what staking is? Would you mind?
I was about to say, let's do a step back for a second. For those, I suspect most listening in will be familiar with the concept of proof of stake. If not, never hurts to do a quick refresher. But what I would say is let's do it in context. Because for you and I, let's say, we're sitting on, 100 quid's worth of Ethereum. Actually, you probably need more on Ethereum. That's a bad example. But, we're sitting on $100 of VeChain or VET or Avalanche or Polkadot. Take your preferred token. We can go with a wallet to a staking application and say, I would like to stake my particular cryptocurrency in exchange for a return, and I will get a return of whatever. And me as a individual who has management of my private keys through an app that may or may not have some sort of biometric or face ID that's easy to use on a mobile device, staking for the most part is pretty easy. You may have some complexity around, well, which validator do I want to stake to? And am I going to get a better yield from one provider versus another? If you kind of peel back some of those complexities a little bit, we're basically just saying, look, I've got some crypto. I want to stake it for a period of time in exchange for some return, some yield. Already,
that was it.
Super straightforward. That's the individual version, right? But the institutional version is different. And this is where I'd like you to do the institutional version, right? Because the amounts of capital are significantly different. The stakeholders involved and the decision making and the I don't want to lead the witness, but certainly the multi-signatories for certain amounts of capital is a complexity or a nuance that may be different. Talk to us about, in a relatively simple level, what are the complexities of institutional grade staking?
Yeah, so a standard path for an institutional workflow starts with security of the assets, and that starts generally, the assets can be held within custody, and what we've seen is a big uptick in the use of qualified custodians through 2025. So as markets mature, they tend to become sort of more sophisticated, and this is a way in which we've seen that kind of come through during 2025. So we've seen the QCs out of the US do particularly well with assets. And when we speak to clients and we're looking to pick up additional flow, what we've seen is that this flow that's being moved, and that's great for us because it's being taken from somewhere to somewhere else, which means it might have previously been locked up and staked with another provider, and now it's being moved to a QC, and that's now right. Now we can go and pitch for that mandate. But generally, it starts with sort of custody, and that's because security over the assets is obviously paramount, and it's not just someone on their phone.
So nuance number one: the bank may not be managing all of the keys all of the time.
Right.
So you have an intermediary between the staking and the bank in some cases, which for those listening in, that's the custodian. They will custody, they will look after some ETH, some Bitcoin. Well, Bitcoin, bad example, no staking on ETH, on Bitcoin really. But stakeable assets will be held by a custodian rather than a bank traditionally.
That's right. And then from there, the assets will be delegated to an infrastructure provider, and they'll have to be integrated with that custodian. So we work with the majority, if not all, of the major custodians that you would have heard of, and we've done a lot of work to make sure that the client workflow is there. And that was one of the things that sort of has to be there from an institutional perspective is workflow. It's like when you start to talk about institutional, the differences between institutional and retail, is like you start to get to things, operational aspects and risk aspects. You start to talk about things like workflows and reporting and things that people aren't going to find that enthralling to dig deep into. But it's really the reality is that all of the sort of operational, I don't want to use the word boring, I'm trying to stay away from that, but like all of those, I'll use more operational items become very important from an institutional perspective, because these guys I come from a risk background, and risk is managed in a very similar way. So they'll go through and they'll say, well, if I'm going to hold this asset, and what are the risks associated with that? One of them will be, credit risk, market risk, liquidity risk. And so when we think about credit risk, is not necessarily quite right, because we're talking about, I guess, security. But custody risk will also be one of them. And so if you're an institution, you got to want to know that your assets are safe, right? That's like 101. Then you're going to have to understand the nuances of what can happen to the value of that asset. And that's where you look at crypto prices. And then you're going to want to understand the liquidity considerations. And then that becomes very important when you're then talking about staking. But just from a pure workflow perspective, generally speaking, those assets will be with a custodian, and they're, the model that we've seen is that they have their core competency and core mandate. They protect the assets, right? That's what they're very good at, and that's what institutions like to use. And that's been proven, and we talk about trust and credibility from a staking perspective, but that is absolutely paramount from a custody perspective. So the assets are held in custody, and then at the back end, we'll have these integrations with other service providers, and staking is one aspect that clients might want within custody. And the model that we generally see is that they utilize third parties such as Twinstake. So they utilize the best third parties. So we have your kind of top tier staking providers that will be integrated with the top tier custodians. And there'll be a few, because what is important from an institutional perspective relative to a retail perspective is diversification, because that reduces your overall concentration risk. Because, so like you said in your example, which validator do you pick, there might not be that much due diligence done, if any, of like which one and why. You're just picking maybe one that shows a higher number on yield and a lower number on fees. You go for that one. But from an institutional perspective, obviously a lot more goes into it, because what you don't want to do is custody of your assets, stake them with one provider, and that staking provider isn't around tomorrow. So you have to do your due diligence, and then a lot of that is put on the custodian as well, and that's why they only want to integrate with sort of tier one staking providers.
Gotcha. So to wheel it back a little bit, we're saying in the bank, they have got tens of millions of dollars of crypto that they would like to have because they think it's a nice asset that has the potential to generate yield and return. There are multiple people in the bank who would like to know where their crypto is and how it's performing and how risky it is. So they require workflow and data to come back to them. Yeah. They're not experts at managing crypto assets. So they hire custodians to look after them, digital Fort Knox, if you will. And those custodians who are really, really good at keeping assets really, really secure may not actually be very good at understanding how to allocate assets to staking. And so they'll work with someone like a Twinstake to say, I've got all of these assets. I'm managing them on behalf of a really big bank with a lot of stakeholders who need a bunch of data and I want to manage the risk, but I also want to maximize the return. Can you help me? Is that broadly how it goes?
Nailed it. You got it. That's
All right.
exactly how it is.
The super simple, super high level helicopter view of the difference between personal staking and institutional staking.
Yeah. Everyone has their core competencies as well. So you tend to see separation between custody and staking because, like you said, if you're a digital Fort Knox, that's what you want to spend 99% of your resources on. And then you say, well, we're spending 99% of our resources on, what we do best as well. And so then you're separating, I guess, church and state there, and then you're allowing diversification because then you can split. If you're an asset, if you're a bank, you might have $1 billion of this particular asset. Do you want to be parking $1 billion in one place, or do you want to park a third in 3 different providers and diversify, not just against one of them going under, but one of them underperforming or having infrastructure issues, etc. So it's an interesting market from that perspective because we're often competing with our peers, but sort of sharing mandates.
And understood. So there's enough business to go around for everybody. So kind of don't be a dick to your neighbor.
Yeah, exactly.
Or don't be too competitive because the business comes around and goes around. Again, an interesting differentiation between the individual person who's got a bit of crypto who'll just YOLO it all in on one person because they don't have that much to lose, or their stakeholder is themselves and they don't have the same processes or risk management overhead that an institution or institutional investors working on behalf of high net worth individuals may have, etc. The bigger you are, the more complicated it gets, the more diversification, the more support you need, the more likely you are to outsource it to third parties. And so here we are. And just maybe to round off this part of the discussion, what is it that you feel Twinstake does especially well in your space? Obviously, you've described the separation of institution, custodian, and then Twinstake in terms of staking provider. But what is it that helps you guys win or to deliver really well for your clients?
I think it's our understanding of how our clients work and what they want. So because we sit specifically within the institutional segment, we don't have to spread ourselves thin. We can be super detailed and super deep. So I have absolute confidence that we go deeper on the staking stack than anyone else. And so that means higher quality data, higher quality and more timely reporting for the clients that we serve. It means better workflows for them. It means better tooling for them, because staking at its core is quite simple. Like you said, right? You've got, if you have a proof of stake asset, it is stakeable, and that will give you a return, a yield, an APR, which however you want to look at it. And that APR vary. On ETH, it's quite low. It's 2.5 to 3%, but on Solana, it's 7 and a bit, and on others it's roughly call it about 5%. So yeah, it's a yield, and if you don't do it, you're essentially bleeding to those inflationary rewards, because that's really where the yield comes from. The majority of the yield, there's an attribution to it. You can get yield through sort of priority fees or block rewards, etc., depending on the chain, but in general it's through the inflationary emissions. So if you hold the asset, like, you should be staking it if you're going to have it for a particular period of time. So you can think of it as just that yield, but there are nuances to it. There's the liquidity considerations have to be understood, and so there's, for each one, it's not immediate. So if you are retail, there are ways in which you can sort of have an immediate liquidity for your staked assets. You can use something, if you've got ETH, you can use something like Lido, which is great. It's the liquid staking version of core staking, but for an institution, that's not necessarily viable, and that's not what you want. You want to just follow, you might be a regulated institution, and the regulators will just want you to follow the underlying protocol rules rather than YOLO into some DeFi protocol out on the risk curve. So you follow the guidelines of the rules, and on staking you have a bonding period and unbonding period, which means it's not automatic liquidity. And so what we do really nicely is work with this mandate will depend on the type of client, but we work very closely with our clients to understand their needs and then build tooling around that. The kind of nuances as you go a little bit deeper into the staking mechanics are.
I can understand at the simplest level, it's things like how many assets do we have with which validators? What's the likelihood of them producing blocks? How much reward do I get from when I get the blocks? Do I want to restake with the same provider when I get my yield, or do I want to liquidate immediately? What's my options, right? Where am I? What are the trade-offs that I might have with restaking the same assets to get more back versus no, I'll take it and run. I need to take it and run now because I see that the market's moving in a way that I'm not happy with. How quickly can I retrieve what and where? Lots. I mean, you can create dashboards forever on this stuff, but I can see the immediate value of being able to provide intelligence because there's very large amounts of money at stake. No pun intended.
One interesting area is the ETF issuer space. So you're right in everything that you say. And the reason I say it depends on the mandate is because an institution can hold crypto for a particular reason, depending on its internal mandate. But for an ETF issuer, they're not clients, but they have their asset allocators that will invest in the ETF, and they don't know when those allocators are going to redeem, or they don't know what's sitting behind them. So they're there to service them and track the underlying. And so if they've got a big sort of ETH ETF, how much of it should they stake? Because they don't know if tomorrow something happens and some idiosyncratic event and suddenly they get redemptions that are outsized to their internal models, and they're like, oh, we don't have the ETH because it's been staked and it's not going to come back for 14 days. And so you get this interesting sort of intersection between a sort of more traditional financial product type, which works on a more traditional sort of operational cycle. For example, on an ETF, it's a T+1 or a T+2 redemption, which is very sort of old school, and you can get your money back if you put a redeem order in at whatever time of day, then you have to get it back within a particular period. So it's very
because in the background there's trades happening, there's kind of assets or different parts of the collateral being moved around that the bank has to optimize in some way. Ditto here in crypto, but because you've got staking periods that are, like you said, 14 days or sometimes 30 days.
Yeah, it's dynamic in nature as well. So some of them are quite fixed, and some of them are time bound. Some of them epoch bound. Some of them are dynamic, like ETH. That's where we try and add value, by understanding the dynamics of the exit queue and entry queue, and where their indices sit within the overall set, and when they should exit, how they should maximize their rewards.
Different strategies for different layer ones, different amounts of yield, different amounts of risk, different cycles, different validators. Roughly how many layer ones are you supporting today? Just out of curiosity, 1, 5, 10, 50, because then I guess for each one of those, there's a body of work to do in terms of understanding the underlying tactics.
That's right. So we currently offer staking on 18.18, but that is, and the way we got to that is really client driven. We're here to service our clients rather than take a view on a particular chain. I have my personal views that I hold but keep to myself, because I'm here to run great infrastructure for our clients. So if they come to us and say, we've got this position and we want to stake it, do you run it? Our job is to have the infrastructure and the engineering capacity in place to say, yes, we can run it and spin it up within a couple of days. So that 18 is not a static number, and it's really client driven. It's been interesting in the market that what we've seen in terms of the L1 as well, right? So last year we were looking at historic L1 launches, and there were really some successful ones, and each had its own individual sort of USP and value prop. Some of them were coming with mixed success, but a lot of them were successful or moderately. But now we've sort of seen a bit of a shift in the industry where fewer L1 seem to be launching. There's a little bit more skepticism about the potential need for multiple launches with sort of similar value props. And so
we don't need fast, cheap, and green anymore. There is enough block space in the industry at this particular point in time. Yes, there are nuances around application specific infrastructure. Yes, there are some interesting diversions in and around privacy and zero knowledge. I spent 2.5 years at Midnight, so from that perspective, that launch was interesting to watch in the last few months. But broadly speaking, do we need another Ethereum killer? No, we need Ethereum to be used well. Ultimately, I think a lot of layer ones today, it's not about whether the tech is better than anything else, because a lot of the clients building applications don't really care for the differentiation that you have engineered, at least today. Maybe in the future that becomes true, but I'm with you. I'm not sure the world needs more layer one block space, but nuances around staking, I'm sure, come up. I wonder, without selling out any of your clients or presenting kind of a negative story, of those at 18, was there an interesting story behind one of them that you didn't see coming, or a particular layer one that you did integrate that was like, wow, I didn't expect insert name of layer one here to be on my list this year, but here we are?
Been a few. There's been a few. The journey of Toncoin has always interested me. So we're one of the largest, if not the largest, institutional validator on Ton. We're one of the first ones on it as well, and it came about obviously through a client. And so we have our market radar, and we obviously have our ear to the ground and what's coming down the pipes in general. But this one surprised me a little bit with at the time of launch, or the time we launched, the scale of pickup, and suddenly it really got a lot of traction, and it was doing really, really nicely. And it's the reason it interested me as an asset is because of the narrative that goes with it around kind of the real world utility potential through Telegram. And I think that's one of the, obviously, Pantera put out their big thesis in it, and you've got a nice story, they've got a huge position, and it's something that you can kind of see and believe in. And I think it's really, like, we're here to run great infrastructure, but just from a personal perspective, I feel like it's got so much untapped potential that's not being utilized from a tech perspective, and the tech is okay, but it feels like there's way more that can be achieved. If you've got something that's linked to an app that's got 1 billion users with some really nice growth associated with it, you feel as though it should be really sort of flying. There should be it's got the potential for a great narrative. But it's just, if you look at the price action alone, it's just been very disappointing.
It's an interesting observation, and again, working for a project where the focus is on real world applications, real world utility, where you've got millions of users and you've got enterprise adoption, and then suddenly the market looks at you and says, no, that's not more valuable than President Trump's meme coin, or that's not more valuable than Solana's latest meme coin pump, or whatever else. So I think that feels like a more structural issue with the market in terms of how people build portfolios or what people value. But I think for me, it's the difference between narrative and implementation. I think Ton have done some really interesting things with Telegram around in-app messaging, in-app crypto payments, being able to create rails in Telegram. I don't have any of the on-chain data around how much actual transaction volume that they see, but it's there and ready to use when people want to use it. Also, I think they were talking about, we had the head of Ton Society on the show a few months back, and they were talking about requiring Telegram vendors to be able to pay their contracts, or to be able to pay their advertising fees with Toncoin. So essentially, you're being able to create a native demand that you can almost force people into if you choose to. Now, whether suppliers push back or whether that had an effect on Telegram's overall revenue, who knows? Right? The church and state issue between the coin operations and the Telegram operations, if Telegram creates friction, that's bad. And unfortunately, whether we like it or not, crypto does create friction in some way. But I'm with you. It is one of the stronger value stories. Whether it was overinflated for a period of time, now it's actually closer to where its real value is. Don't know. Hard to tell. Always do your own research, not financial advice. Please don't buy any tokens based on this podcast. Thank you.
From a purely staking perspective as well, this one was interesting because it was complex to run, or is quite complex to run, and I quite like complexity. Complexity is what we thrive off, and we're a professional outfit, and we've got some really great engineers, and so it's nice when things are simple in many ways, but like we do thrive off the complexity of trying to figure something out, and we can then do something that someone else can't.
There we go. Interesting one. And thank you for sharing the story. We do occasionally get questions as we go through from the audience, and there is one here, which is probably in line with some of the setup questions. This question is from Lewis or Louis. What are the key infrastructure challenges institutions are facing when moving from custodial to non-custodial staking? Is there a helicopter response for that particular question? Or what's your experience so far?
So we're a non-custodial staking provider, meaning that, and we set up specifically for that and never thought about sort of taking custody. I mentioned about the competencies and what we do. Like we didn't want to have to. We looked at, well, within the ecosystem, it was looked at whether we wanted to start up a custody solution as well. Decided to get into sticks of staking. It means that when we go to clients that we can sort of, we're talking about risk, we don't add any sort of counterparty credit risk to the workflow. We don't hold private keys. We can't take funds. The thing that we can do is there's downside risks to staking, and we can potentially lose some collateral if we do a terrible job. And obviously we've got multiple lines of defense against that. In order for it to not happen, and then we insure our customers and clients against the loss of any funds anyway. So we've really sort of made sure that risk is overall minimized. But from a credit risk perspective, we're not adding any additional because that sits purely with the custodian. What was the remote? Sorry.
I guess the challenge there then in that case is more actually around what structure as an institution do you want to have? Do you want to have a custodian with multiple staking solutions provided to the custodian, or do you want to have a combined, or are you comfortable with the risk of having a custodial staking provider? Maybe that's more of the framing of it rather than anything else. So.
One interesting thing that we've seen is that when obviously the institutions have their own decision making, but some of the time it's driven by the regulatory view as well. So I mentioned about ETF issuers being a significant segment for us. So the US regulators have recently come out with what they call the safe harbor rule. And so I don't know if you've sort of seen, but in the US, staking wasn't permissible under the ETF issuer setup or trust structure. And they had a lot of sort of hurdles to overcome around sort of keeping it passive, and there were some issues around custodial versus non-custodial, and they came out with these 14 points very recently that said this is what you can and can't do. Staking is permissible, but only under these 14 points. And one of the points was that you do have to have everything at arm's length, meaning that you have to use a custodian. That custodian has to use a staking provider. So again,
that's handy for you guys, I guess. That's probably positive news.
It is handy for us. It was very positive news. I agree with the ruling. Like
obviously, I'm fully supportive of this. Excellent solution.
Because what you can then, you've got some big players over in the US and from a custody front that pretty much have a monopoly over that segment, and they also run infrastructure, and so you're keeping everything in house. But again, if you're thinking about reducing risk and increasing the diversification, and really it's for the client benefit, which is obviously what the regulator is there for as well. It does make sense to sort of separate it out. Everyone sticks to their core competencies. Everything's arm's length, and then you can utilize multiple providers and reduce overall risk within the asset workflow.
Got you. So, Louis, great question, or Lewis, if you're there, thank you so much for the question. I appreciate that one. Let's get on to the current state of institutional adoption or institutional interest. 2025 was seen as the year of institutional adoption. Crypto presidents more positive regulation, at least stateside. And it's unfair to skew the entire industry towards what happens in the United States, because jurisdictions like the UAE, Singapore, Hong Kong, Switzerland have been leading on digital asset regulation since long before the US decided to take a more balanced perspective. But the upshot of 2025 was typically institutions are going to take a position on crypto. We're going to see more distribution of crypto through institutions. We're going to see institutions holding digital assets. We're going to see some interesting products appear that are institutional focused. And we saw a market that was maybe a bit less buoyant than we may have expected. Obviously, there were a few hurdles along the way. Bybit, the events of 10th of October from an exchange perspective that had a bit of an impact on liquidity and general market positions. Lots still went on. How would you summarize 2025 from your perspective, looking at, I guess, institutional staking institutions engaging actively with crypto?
It was absolutely a positive year from an institutional perspective, if you zoom out and then take a longer term view. So I think I referred to it as transformational in that way before. It's like, but I thought it was a super interesting year, because if you look at people tend to just look at prices. If they say, how was the year? They go, well, what did the price do? How much did Bitcoin get up? Right? And then you look at it and you go, it's weird.
My everyday. This is my everyday life as a CMO for a layer 1 protocol on Twitter. It's like, cool, great adoption, great partnership. What did the price do? It's like, yeah, okay, guys, thank you. I hear you.
So you have to look through that. You have to be like, all right, because I hope prices would have done better as well. That's, but from an institutional only perspective, it was really great, and certainly for the long term view. So yes, you don't, it's a bit US centric to talk about, just Trump and what happened there, but it was a big factor for the industry, and it is built out some huge sort of institutional momentum. What I thought was interesting through 2025 was you had these institutional sort of building blocks going into place. And so each year, more and more is happening from that perspective, but there's big blocks that we're going in 2025 that sort of makes sure, like, it reduces the overall systemic risk of the industry in general to, each year that we go through, which is great, right? There was times when we were like, I'm sure you felt the same. It's like, is it over? What's going to happen? But now it feels like you raise the floor each time. The floor is much, much higher now than it was, because you have so much of the pipes built, so much of the foundations that are built.
That's a nice way of framing it.
Now we need to do is just sort of, build out the bricks, right? Which is the somewhat easier part, but who knows in what form that's going to take. But so you had the tailwinds of regulation coming in, and as I said, like, institutions listen to regulators because they can't fall foul, and they don't like to lead the horse. They don't like to take on too much risk without those rules in place, which means that from a regulation, as mundane as it sounds, has to sort of be there, and there has to be clarity, and it has to be ahead of the institutional adoption. So we saw some excellent developments there, and we moved ourselves forward, not just from a staking aspect, but we had the Genius Act, and now we have the Clarity Act coming through, a change in the SEC chair, and a much more positive sentiment coming out of the US. And that generally then drives other areas as well. I mean, you mentioned some regulators are ahead. The UAE is great. I really love that region. I think we want to do much more there. And the regulators are fantastic to work with. But the US does have such an outsized view that it does tend to sort of lead Europe in many ways. So it's great that we've seen those, and we've got MiCA coming out, 2026 harmonization of MiCA coming through, but there's still a little bit of fragmentation. I'm sure we'll see how the US evolves, and then we'll get down to some of the lower risk areas that they'll tackle next in Europe as well. So regulation has been a real bonus from a positive story through 2025. And then we have these, refer to them as entry points, institutional entry points. ETFs, I'm a bit obsessed with ETFs at the moment. We service a lot of ETF issuers. I've got, I think this year is going to see a lot more growth in the ETF space as well. But we've already seen a decent chunk of growth, and it's a really nice entry point for institutions and asset allocators.
And by that, do you mean more diversity in the ETFs available, more of the same coins and ETFs in more institutions? Could you just qualify that a little bit, just in terms of what you see? Maybe we're already on to 2026 predictions, but I feel like that's a good one to get us started.
That would be one of mine. The growth of the ETF, ETP space. It's around 250 billion-ish AUM, assets under management at the moment, and should go.
I think 6% of total Bitcoin. I'm looking back to, I think, the Masari crypto thesis from back end of last year. About 6% of total Bitcoin is currently allocated to ETFs, which is not bad.
Yeah, I mean, it almost, we're talking about that floor. It almost sets that floor, and you got that sort of institutional demand. It's not just institutional demand; it's full demand into ETFs. So I mean, the regulators in the US have made it easier to apply for new ETFs. So I think there's over 120 in the queue there at the moment, and so we're going to see more being issued, but also we're just going to see some of the larger ones gain more traction as well. So that space is going to be very competitive, but it's going to be booming through 2026, and it has been, and it's had a good 2025 as well.
So broadly, more demand for crypto assets through financial institutions, with ETFs being the way that customers or high net worth individuals or pension funds or whoever consume that exposure. Exactly right. I think it's roughly about 3/4 still retail allocation and about 25% institutional allocation to ETFs. But that is the entry point. And I think they've done some really excellent things in the US in terms of allowing retail users to enter crypto that might not have otherwise. Because we still probably take this for granted. Like, it's still a bit of a barrier for people to come into crypto, right? You speak to a lot of people that aren't crypto native, that are like, I would like to get some Bitcoin, but they don't know what they're doing. And it's still not the easiest thing in the world. Right? Or even, I believe crypto is a kind of high growth tech stock equivalent. How do I get some crypto? What is a crypto? Which cryptos are good? And again, ETFs are great for that, because then you've basically got kind of basket type products saying, look, we'll do the diligence for you. If you just want some crypto in your portfolio, great. If you know you want Bitcoin, I mean, honestly speaking, go get Bitcoin. But
you should.
If not,
I agree, you should. But a lot of people will say, well, there's IBIT, there's BlackRock's Bitcoin ETF, or I can go onto my brokerage account if you're sat in the US, and you can do that on your phone now and say, I'd like to purchase this ETF, which follows the underlying asset. So we're seeing, like, that's the easiest way, or that's an easy way in which people can enter the market that might have been put off by having to go and get actual Bitcoin themselves. And so that will come through and will change, but we're still far too early on that in terms of like actual mass adoption. So ETFs are generally going to be the route of choice. And we're starting to see, from an institutional perspective, big segments like, pension funds and endowments and really large funds that want allocation. So from an institutional perspective, I speak to a lot of crypto native folks, and I speak to a lot of sort of more traditional folks, and of the more traditional folks that I speak to, they want allocation into crypto. And at the moment, it's generally, we need 1% to 2% allocation into crypto into overall portfolio.
Yep.
And so that's where we are. And then they say, well, okay, 1% to 2% of what? Crypto. And then they say, okay, well, that majority of that's going to be Bitcoin. And then people are starting to talk about ETH. But that's, for a lot of people, that's about it at the moment.
Yep.
So you can think about what the upside is going to, the upside potential that exists there is because you're only talking about, from a traditional portfolio, you're only talking about 1% to 2% allocation, and even as an industry, for us to get to that point is fantastic, right? To be thought of as a part of an overall investment thesis from a traditional firm is fantastic. And that 1% to 2% is likely going to go to 5% to 10% at some point. Don't know when, but at some point. And then it's likely to go beyond just Bitcoin. And so, but we are still at the point where it's like, it's small allocations, and it's to make.
Which is awesome explanation, Andrew. And I love that you've taken it there, because for everybody listening in being like, oh, the institutions are here, why didn't my top 200 coins suddenly start booming? That's exactly it, right? Is that those distribution channels or those inflows today are still as nascent as retail flows were 5 years ago.
Yeah.
And somewhere down the line, people got into Avalanche or Polkadot or VeChain or maybe a bit of Pepe on the side just for some fun. But broadly speaking, most of the rest of the world was still in Bitcoin and ETH not long ago either. They're now Web3 natives, and we've got the rest of the group following along the same journey. Albeit, I suspect the due diligence or the ability for institutions to present top 200 projects with some slightly more reasoned due diligence may be better than people just gambling on, I like the color of that token, right? Which I think may, like you said, raising the floor. I think that's a raise the floor moment. When people say, okay, what about the other crypto assets? Well, some of them are performing better than Bitcoin. Okay, how do I get that? That's where we're going. But like you said, that's not a 6-month thing. That's a softly thing.
Certainly for the significant size that we want and the growth that we actually expect as an industry, and we're very likely to see, that will take some time to come through because the size comes from those types of institutions and those types of allocations, and it will be, that's where we are today, and we are a little while away from allocations to more traditional firms and larger funds down the stack, down the sort of proof of stake stack. So I have absolute confidence that we're going there, and we've got these building blocks that are in place, but we do need a little bit of time and history and a little bit more credibility as an industry to get to those levels. Because I think sometimes we do, like, if you're in the industry, right, you have to sometimes keep zooming out until you get right out there, because like we've done incredibly well as an industry to get to where we are, and I do believe that like that floor is there, and there's that growth ahead should be theoretically easier than the last 5 years. But we have to think about the overall size and the way in which the wider world works, and it's still pretty small, right? If you think about, like, if you just compare it to the traditional financial sense, we have some macro themes and mega themes that are coming through in crypto that have huge potential. We haven't touched upon stable coins or tokenization or anything like that, even prediction markets, which is great at the moment. But we've got some mega trends. For us, they're mega trends, but they have the potential to be also mega trends within the overall system. That's if people are talking about the institutions are here, why here the levels that I expect is because like we need those to interact with the size and scale of the more traditional assets, and they have the potential to do it, but it will take a little bit more time.
Got you. So we're still early, but ETFs definitely on the radar, and I guess the call out also to those watching or listening in is ETFs will move the market, but maybe not at the speed that crypto expects, or that we've seen some Web3 native things move, which I think is fair. But again, that's part of the maturation of what we're doing. Is the rest of the non-Web3 native world doesn't always move at the same pace. We're getting close to the end. We've probably got about 5 minutes left to go. So I might press you for your 2 and 3 top predictions for 2026. Shout out to anybody who's still here this deep into the show to hear Andrew's second and third. What are the other 2 things that you're excited for or expecting this year?
So to round out the ETF one, the first one was around sort of the entry point. So I would call out digital asset treasuries as well. So I think that was something that arose really sort of midway through last year. Similar model for anyone that doesn't know to sort of MicroStrategy, with what MicroStrategy did with Bitcoin. Others have followed now, and you have Bitmine, etc., with ETH, and Upexi and Solana company with Solana, and essentially now that's the core reason to be, is to hold and buy that asset. And so I think we'll continue to see the rise of those 2. You talk about someone wanting exposure to crypto that doesn't want to hold all the keys and wallets themselves, then this might be an excellent way for them to do it. So you have ETFs, digital asset treasuries, excellent exposure and entry points to the market. I think we'll see the continuation and growth of those 2 areas. I think that the macro themes will be, we keep talking about real world utility. I think it's going to be, a decent amount the same in 2026 and 2025 on those macro themes. Maybe privacy, you're the expert here, again, your midnight midnight 10-year. But I think stablecoins, tokenization, and now prediction markets, I think they move from sort of more experimental sort of smaller numbers. They're still not great numbers. I think each of those markets is going to sort of triple in size through 2026 quite comfortably. I think I'm being quite conservative there. And that gives us, as soon as you get to that point, then suddenly, like, I read the FT every day, right? The number of articles I read that mention those kind of crypto themes now relative to 12 months ago, 24 months ago, night and day. It's almost every day now. So as soon as you start to get the 300 billion of stable coins to a trillion plus, then you're really talking. And so then the flywheel already, like, I think you have to see that growth this year, and then suddenly it'll sort of kick off.
I think it's a strong indicator when you that end of itself, that's everyday adoption, right? When a friend of mine who runs a PR agency once said, if you want to get anything crypto or blockchain into the Financial Times, you've got to commit mass fraud. The reality now that you're actually seeing commentary on crypto assets subsegments or subsegments of Web3 applications, I think that's also a good indicator.
I think it's a fantastic indicator. Today, Lloyd's Bank wants to tokenize their deposits. It's like a front page kind of type story. And you wouldn't have seen that 12 months ago.
Not Lloyd's. I mean, Citi have been looking at that for years, and have released it now when they're able to. I think that's now people jumping on the bandwagon saying, look, I've got deposits that have the potential to move globally, to improve liquidity and speed, help us. Almost, I feel like that's now a table stakes, again, no pun intended, move for banks now. Is if you've got competitor banks that are able to move liquidity and move money around the world faster, and you can't, you're going to lose clients. And so welcome to tokenization of traditional financial products. Yeah.
And that's, those, we've been talking about those themes for a while, but as soon as they start to get those mainstream traction, that's where you really start to see the uptick. And it's not really the staking world, but I'm super excited to sort of see it come through, given my history in banking as well. The only other prediction I had is around staking, that I think it's, we see the ground view of that. 2026 is going to be a year when it becomes sort of the institutional default. We've still seen some institutions that were a little bit hesitant, and with the complexities and understanding the risks associated with it. I think they're all essentially there now. Like, we're starting to see, like, even the biggest and slowest moving, like, we've got it past our risk committees, and we understand it more. We understand all the complexities, and then we're going to see that that's the default, which is great for us. But it also gives indication of where we are on the risk curve, meaning that if you think about institutional yield, like, one thing that we do excellently in crypto is come up with these fantastic solutions, super elegant. They work. They seem to work really well on paper. They're designed beautifully, and they're awesome. But you then take it to an institution, and as soon as you go beyond step one of some complex way in which you attain yield, it's just a no-go. Because the way in which large institutions work is, it's not one person being like, oh yeah, it sounds good, let's do it. It has to be presented. It has to go through the right committees. It has to go through the right sort of levels of review. And we're not close to being where we want to be in terms of, like, we haven't talked about DeFi. DeFi will have its time and will grow this year, but in my opinion, not as much as it potentially should, simply because they're not ready for the complexities that it comes with, and we haven't proven out as an industry that we can, tighten up around security and hacks, etc. So where they are is now they're at staking, which is essentially the risk-free rate, right? That's where you're like, okay, we've understood all the considerations, and we're okay to stake the assets. They're not there yet with all the flywheels that are associated with higher yield.
Which, for everybody listening into this, if they think back through their own personal journey of the first time they bought some crypto, and then the first time that they actually staked some crypto, and then the first time they actually engaged with a DeFi product, and how long that took you as an individual to move through, and that's where we are now on the curve in terms of institutions, is probably just kind of a helpful parallel to say, well, where are we in the journey of what that institutional phase of mass adoption is like? Andrew, absolutely fascinating conversation. Seamlessly blending the institutional world, the staking world, the retail and crypto user world, with some fun stories along the way. I've learned a lot from this conversation. I'm sure those listening in have as well. Thank you so much for taking an hour to share your wisdom with us. Let's check back towards the end of the year whether your predictions are on point. I suspect it's almost a foregone conclusion that we're going to see growth in the areas you talked about. But thank you so much for joining us. Thank you for giving us an intro into Twinstake, and go have fun out there. Have a great 2026.
Thank you very much.